Welcome back, fellow investors. Today we're going to be talking about why stocks have been falling in the last few months, why they have risen in the last week, and also what my expectations are going forward. More specifically, I'm going to tell you the 3 reasons why I think you should be buying this dip. Now, first of all, we saw the SPX rise to about 4,600 in the month of July. However, since then, it has gone down over 10%, entering correction territory. Now, interestingly, after finding a bottom on October 23rd, we have now witnessed a pretty unique run-up in stocks, giving us 8 straight green days, something we hadn't really seen in a very long time. So first of all, why have stocks fallen in the last month, and what is causing this? Now, there are a lot of factors that affect stock prices, but without a doubt, one of the most relevant in this recent sell-off has been the rise in interest rates. And by this, I mean, of course, the increase in the yields in long-term treasuries. Now, we can see this, for example, reflected in the 10-year treasury yield. As we can see, there's been a pretty negative correlation between yields and the stock market. In other words, as yields have gone up, we've seen stocks go down. Interestingly, the recent rally in stocks has also coincided with yields beginning to turn down. So, first of all, what is causing yields to go up, and what can we expect in the next 6 to 12 months? Of course, yields are responding to the higher rates set by the Fed. But there's a lot more to this story. Fed funds rates have been high for quite some time, but yields have only begun to pick up at this rate in the last couple of months. And there's a couple reasons for this. First of all, term premium. Now, term premium is the compensation that investors require to bear the risk of changing interest rates. In other words, in an environment of uncertainty, investors require a certain premium above the price of a bond in order to hold that quote-unquote risk. Now, over the last few years, term premium has actually been quite low, as Fed policy was quite predictable and rates were very low. However, as we can see in this chart, term premium has exploded to the upside in the last few months, showing that investors are quite uncertain about the outlook for interest rates. Now, this can probably be attributed to the aggressive moves we've seen by the Treasury in terms of funding the Treasury General Account. In other words, we've been seeing government spending ramp up, or at least plans for government spending, and as a response, of course, the Treasury has to issue more debt. At a time where perhaps we can speculate that there aren't as many buyers as there once were. International buyers like China and Japan are beginning to reduce their amount of treasury, and given the bear market we've seen in treasuries, the appetite for government bonds has certainly decreased. In simple terms, there's been an increase in the supply of treasuries without an equal increase in demand, especially now that the Federal Reserve is not buying bonds. On the other hand, we could also associate the recent rise in yields to an increase in inflation expectation. This can be seen in the rise of TIPS. These are Treasury inflation-protected securities. In other words, their price reflects the expectations of inflation. When TIPS go up, this is a reflection of higher inflation expectations. So, with the increase in term premium and inflation expectations, Treasury rates have been going up, which has put downwards pressure on stocks. As we know, in order to value stocks, we use discounted cash flow models, and the higher the risk-free rate, the higher the level of discount, which means a lower present value. We can also think about it in terms of liquidity, as lower bond prices and more volatility have a negative impact on global liquidity by lowering the price of the collateral on which that liquidity is built. Now, having said that, I think the current price offers us a great entry point to go long the market. First of all, in terms of rates, I think there's a high probability that we could have already peaked. While some investors are still concerned about inflation, we've seen clear disinflationary trends in the last few months, and I would expect these to continue, especially as we approach a possible recession and the economy slows down. This is already reflected, for example, if we look at oil prices, which have been falling in the last month. On the other hand, we're also entering a typically strong period for the market. As we can see in this chart, November to April has typically been the strongest 6 months in markets since 1928. On the other hand, we can also take this as a contrarian indicator. We can see here the NIM Exposure Index. This measures the average exposure to US equities reported by its members. In other words, it shows how much exposures money managers have to US equities. And typically, this can be seen as a good contrarian indicator. In other words, when money managers are underexposed, this is typically when stocks tend to bottom. On the contrary, stocks tend to top when exposure reaches maximums. We can see this if we compare the NIM Exposure Index with the S&P 500 index. And on the other hand, we also have the Fear and Greed Index, which, when we were reaching market depths of about 4,000, entered into extreme fear territory. As we know, it is typically under these events of extreme fear when markets really find a bottom. Overall, I think the stage is set now for a year-end rally and perhaps also a rally into the first quarter of the next year. Rates are beginning to top, and the same could probably be said about the dollar index. Of course, a weaker dollar is also supportive for risk assets. Overall, if we look at my XPX chart, based on my early wave analysis, I believe we could be beginning a final impulse in a wave 5, which should take us to new all-time highs, perhaps north of 5,000. From a more macro perspective, I actually think that the economy is going to begin to weaken from here, but this will be seen as good news by the market, as they will see no more need for Fed tightening. Of course, bad news will be good news until the bad news becomes too bad, at which point we will indeed get a recession, which could be happening towards the second half of 2024. Thanks for watching, and if you like this type of content, don't forget to follow me on Substack, where I do a free weekly newsletter, plenty of technical analysis, and in-depth reports on stocks. Check out the link on the description, and see you in the next one.